Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets, what we're looking at for our portfolios. As always, please don't use these videos for trading purposes. They're for information only. Start with the weekly chart, gives us the biggest long-term view of what's happening in the market. This goes back to about 2019 here on the left, so a little over 5 years trading that we're showing here. This is the COVID sell-off and then the giant rally that followed as money poured into the markets from the federal government and the Federal Reserve. Then 22, as interest rates started to rise, we had that nice little bear market there to kind of calm down the inflation. And now it is looking like the market might be starting a new uptrend. Certainly, 23 had gotten off to a bit of a bang there. Certainly retracing a bit in the last few months. But markets tend to do that. They rarely just go straight up in one direction. But as I see it here, we're looking at a weekly long-term chart that's showing a solid uptrending market there. So certainly tried to test and break some support in recent weeks, but looks like it's held, and we might be moving on from there. So maybe that's some good news for people's 401ks there. If we go down here to the daily chart, this gives a little more detail about the last 2 years trading. The market shows some of the major moving averages that we might look at. That is still showing a trend that's downward, but certainly having hit support here and bounced off it, it is looking like we may be changing trend there. Certainly nice to get through this 4,400 level here on the S&P 500, but starting to look positive. And if we had the daily chart here and the weekly chart going up, then I would say we probably want to have some of our more long-term money invested, that the market's looking instructive again. Come down here to look in a little more detail. This is a 2-hour chart, and this shows about the last 6 months trading. There's a lot of details of kind of the ups and downs of, a strong week and then a week or two of sell-off. And you can see the channel that we've been moving down in for the last 3 months, and it looks like it's just breaking it now to the upside. So might be a good time to stop running for cover. We'll see. It still has to get above the 4,400 here, but we did start adding on some risk as this turned. And in particular, if we look at some of the internals of the market here, down below, this is the percent of the S&P 500 that's in an uptrend. And you can see it's down at about 23 with 20s. It had been trending down for the last couple of months as that downtrend had been happening, as you see there. Well, now it's bouncing up. We're about 44%. So as this bounce started to happen, a lot more stocks started to participate, and that's what you want to see. Normally in rising markets, you see it up here about 80 or so, but this does look like a change in trend in terms of the percentage of the S&P that's in an uptrend. Same thing, the next line down is the advanced decline line on the New York Stock Exchange. Just shows us the number of advancing stocks versus declining stocks in terms of shares. And you can see that it looks also that it has turned here in recent weeks. So that's positive. And then finally at the bottom, this is the VIX, the volatility index. And this measures what people are willing to pay for insurance protection on their options trades. And you can see that it's just absolutely fallen off a cliff here. We were at 22 just a couple of weeks ago and now down to 14. So all of these things together are saying, okay, it might be time for some positive action here in the stock market. And so all those are pointing to good things. And certainly you want to be cautious still. A lot of items happening with the interest rates and inflation, but it may be that the Fed is done raising rates, and or very near that. And if that has happened, that might be positive for the stock market. So come here and get a closer look at the problem. We can see here the interest rate on the 10-year U.S. government bond. And obviously here in 20, it had been, represents about 0.5%. And today this is 4.5%. So this is the rise in interest rates that's caused all the problems. And certainly the bear market that we had in 22, you can see as the rates just came way up. The sell-off that we had in recent months, probably again, they seem to be moving in lockstep, that as the rates rise, it's negative for the stock market. But perhaps certainly the last couple of weeks it started negating, and that might be some of the action that we're seeing now. That you almost could watch this chart and get a good idea where the stock market's going to go. That's just that doesn't always work that way, but that's the way it is at the moment. And if we look at some of our economic indicators, certainly here GDP growth rate, I mean that's solid, 4.9 on the last read, as opposed to 2.1. So a lot of talk about a recession coming and such, but it's not here now. We haven't seen it. This is a little concerning, the non-farm payrolls, the jobs number, but they're still positive. Certainly lower than the previous reading, but 150, they're still positive. So that's a good sign. Inflation rate 3.7, and it gotten a little higher, and that's the worry is that the Federal Reserve will have to keep raising interest rates to choke this off. But we were at 8-9% last year, so this is still a positive thing. And I like to look at retail sales here, and if you see here at the bottom, they're still staying positive. So a lot of talk again about a recession coming and all that, but we don't have the indicators that are there yet, and don't like to generally react until we actually have information in front of us that says, yeah, it's a problem. And more, we're seeing some solid or okay economic indicators, and a market that's behaving like it might be trying to bottom a little bit. We'll see. And then if we come here to, this is the forward earnings estimate on the S&P 500. Analysts will put together their estimates of what they think the S&P is going to earn in coming years. And here we go to Q4 of 24, so that represents end of the year next year. Analyst estimates are still high, so I'm not seeing the data necessarily to say that anything's rolling over yet. Not that it couldn't happen, but it hasn't as of yet. And then if we go here to valuation on the markets, this gives us an idea of, let's say 20%, 20 times earnings. That's where the market would be, 36.20. So it gives us an idea of over valuation or undervaluation. Certainly we're way off of we're not undervalued or undervalued or anything like that, but it's not super excessive. At times it's gotten quite a bit away from here, like in 21. And so as interest rates started to rise and we were already overinflated, that's why you had that bear market there. And then below here, you can actually see S&P earnings. They were starting to come off there, but it's solid and going in the right direction. So it's hard for me to look at these things and not say, okay, we've got solid earnings, solid economy. The market seems healthy for the moment. And so all of that could be positive. So I'll go back here to, again, our weekly chart. The whole uptrend is positive. So we've kind of had been a little bit of risk off, and now have certainly moved in the last week to having putting some of that back to work, and hopefully this trend will continue and move on. But they said we watch our portfolios carefully for our clients and move them around as necessary to have an appropriate amount of risk for whatever the market's doing. If you'd like to hear more about what we're doing with that, I'll put up our contact information up here. If you have any questions, want to hear about what we're doing in our portfolios, happy to discuss that. There's our contact information there. Otherwise, I hope this was informative and helpful. And thanks for watching. We'll see you at the next update. Thanks so much.